What is going on, traders? So Jerome Powell finally caved in his Jackson Hole speech at the symposium on Friday. It wasn't an official FOMC meeting, but it might as well have been. It's actually the most hawkish that he's ever sounded, really, since they started raising rates, or actually since the start of his term. So in this video, we're going to go over what he said, what it means for the markets. Of course, I will give you a market update, especially after these events. We'll talk about upcoming events because there are a few key ones, what that means for your portfolio and your trades, and why we continue to hold a hedge against the market in the form of puts mostly, but we also opened up other trades such as covered calls, and we even have vertical spreads that are bearish against the market as well for those who don't want to be trading in single options. So I'll go over all of that stuff in this video. You definitely want to stick around till the end because it'll be jam-packed full of information. Let's get right into it. So the market wasn't expecting Jerome Powell to say anything significant on Friday, and you can actually see this in the VIX. The VIX is the volatility index that tracks the S&P 500 options and shows you how market makers are betting. But it was obvious to absolutely nobody that Jerome Powell would actually sound the most hawkish that he's ever been during a Jackson Hole speech and not an official FOMC meeting. If you remember the last FOMC meeting that we covered, Jerome Powell actually tried to say that the rates, the federal funds rate was back to neutral, which nobody agrees with that, not even the Fed members. So what did he say that was so hawkish? He said reducing inflation is likely to require a sustained period of below trend growth, which supports talks of a potential recession. He also said, moreover, there will very likely be some softening of labor market conditions, something that he's never talked about before. He's used the labor market as sort of a crutch to say, hey, look, the labor market is doing well, so we don't really need to go that aggressive with our Fed rate hikes. And he also used the labor market to justify that we are not in a recession. But he further went on to say, while higher interest rates, slower growth, and softer labor market conditions will bring down inflation, they will also bring some pain to households and businesses, something that he's never said before. So he further reiterated that the overarching focus right now is to bring inflation back down to our 2% goal. Now, historically, when inflation has been double digits or near double digits, the federal funds rate had to keep getting raised above CPI until the real federal funds rate, which is the Fed funds rate minus the CPI data, is actually positive. It has been negative really for almost 11 years. It briefly went positive slightly in 2019, right before the COVID crash, but it has been negative most of the time for the better part of 11 years. We went over that in the last video. And if you look now at the FOMC watch tool, you'll see that almost 65% of the market is betting that the Fed is going to do a 75 to 100 basis point rate hike. And the VIX is steadily climbing after hitting a low of 20. You can see here on my chart that the VIX hit our support point here. I drew this a long time ago and I have not moved it all year, and the VIX came down to this level and then bounced back up, and we're now at around the 27 level. Now, before we get into upcoming events and before I get into a full detailed market analysis, I'll tell you why we actually bought puts here, why we maintain hedges here, and it wasn't because of the Jackson Hole speech. Nobody, like I said, nobody actually knew that Jerome Powell would sound the most hawkish that he's ever sounded since he took that seat. And obviously, nobody expected a 4% day on Friday. However, this is a major technical level that we hit after completing the same fractal that you guys know I've been pointing out for months now. The same fractal that we completed back in February and March, we concluded in mid-August. And that just happened to fall in line with the Jackson Hole symposium. And also this was the conclusion of all of the mega cap earnings. So all of the mega cap companies, the top companies in the world, Amazon, Google, Apple, Microsoft, etc., had already reported earnings. So all of the guidance was in, all of that information was in, and it is now priced in. There were no further catalysts from here except for the next CPI data, which comes out September 13th, and the next FOMC meeting, which comes out on September 21st. Besides that, there are no further catalysts, so we expected at least some volatility. Now, obviously, as I said, nobody expected a 4% down day on Friday. However, the best setups occur when fundamentals and technicals match up. And these technicals here definitely justified hedging your portfolio with a variety of plays. You could have bought puts, you could have bought vertical spreads, you could have sold calls against your shares, you could have done all of the above. And for those of you that were asking me when we had done a couple of lives around this time, is it time to buy? And I was saying that this is not the time to buy, because if you had not purchased this whole time since we entered a bear market until now, the time to buy is not after the most violent bear market rally or the most violent market rally that we've seen in a very long time. That is not the optimal time to buy. And unfortunately, the market sucked in a lot of liquidity, and now you are seeing the FOMO buyers get dumped on here. I'm certainly not trying to say that I'm Nostradamus or some sort of prophet. We're just in the habit of taking optimal plays and avoiding non-optimal plays. That's it. And the more you maximize optimal plays versus non-optimal plays, the better off your portfolio will be. So for those of you that are fans of this channel, you know that I hedged an entire portfolio. I used my entire Robinhood portfolio to hedge, and this account is now up 38% in the last month. And this is a completely hedged portfolio. It is full of puts only. And for those who couldn't afford leap puts, because leap puts are expensive, long dated puts are expensive, there are many ways, many tools at your disposal that you can use to hedge. In this case, we also sent out an alert for selling the 315, 320 call spread on the Qs, which is currently up near 30% as of the time of this recording. We also sold covered calls on Apple, Amazon, and Google as they hit major technical resistance levels as well. And if you're fans of this channel, you're obviously familiar with the Tesla trade that we did on the Tesla split day. As I mentioned, Tesla, as well as other mega caps, they tend to go down on the split day because the rally, the pre-split rally, happens before the split, and then the market takes liquidity from FOMO buyers and dumps on them on the split day. This happened with Apple, this happened with Google, with Amazon, this happened with Shopify, this happened with Tesla before, and now it's happening with Tesla again. And those puts are up 86%. As I always say, if the only thing you know how to do is buy stocks and sit on your hands and hope that they go up, well, you're not giving yourself the best opportunity to win in this market. You can play any direction if you have the tools and the know-how to do so. Now, we close signups for August. However, we will have spots opening up for September. So if you want to apply to the Academy, use the link in the description below. You'll get access to the courses, the chats, the alerts, the analysis, the Zoom calls with me where you can ask me literally any question. We can dive into option strategies deeper. We can dive into day trading, technical analysis, etc. That link is in the description. So sign up if you want slots for September. All right. So in terms of relevant events coming up, and then I'll dive into a market analysis and give you the technical levels that I'm looking at. We have the August jobs report coming out on September 2nd. So that is going to let us know whether we now have an uptick in unemployment. And remember, the uptick in unemployment after hitting lows, that is usually another signal that we're about to enter a recession, in conjunction with the yield curve inversions that we saw between the 10-year and the 2-year, and the one that's about to happen between the 10-year and the 3-month. An uptick in unemployment after hitting lows is usually another sign that we're about to hit a recession. So it'll be very interesting to see what those numbers look like. Now, if the numbers come in even stronger or just as expected, then the Fed will have no choice but to raise, because the labor market is still very strong and the Fed can actually justify a continuation of aggressive rate hikes. We also have the CPI numbers coming in September 13th, which will give the Fed another heads up, because remember, the next FOMC meeting is September 21st. So they will be able to digest the jobs report. They'll be able to digest the CPI data as well, and then make their decision on September 21st. I think the market now, as we showed, is expecting a 75 basis point rate hike, and they might just pull the trigger and do it, which will be 3 75 basis point rate hikes, the highest and fastest rate hike process that we've seen since the early 80s. All right, in terms of technical levels on the S&P 500 and the Qs, as I said, we've been tracking this fractal really for months now. And even in the middle of the bear market rally, I was marking that level that we are at now as a potential resistance point, or the level that we got rejected from. We got rejected from that level, and we are now down 7% from those bear market rally highs. In terms of support on the S&P 500, we have major support around between the 385 to 388 level. Let's just call it 390. So between 385 to 390. Whether we take out the June lows or not really depends on how aggressive the Fed is and really depends on the economic data that comes out. We are seeing an uptick in oil again as it is approaching $96 a barrel. And as I said before, the federal funds effective rate minus the CPI is still heavily negative, the most negative that it's ever been, that this country has ever seen, at minus 6.8. So if the next CPI data comes in, worse than expected, and we are seeing commodities tick up again, and we're seeing inflation tick up again, well, then I think the market has a really huge possibility of breaking those June lows, because what is implied is that the Fed will have to keep raising aggressively in order to get this federal funds effective rate back to positive at least. And that's going to take a long time, and it's going to take a lot of aggression from the Fed, which would kill the value of stocks and really tank the market and tank the economy, to be honest, because money is going to be so expensive. Businesses won't be incentivized to borrow. Individuals won't be incentivized to borrow. You're going to see spending come to a halt. So it really depends on how bad the CPI is and how the Fed reacts to it. But right now, we are nowhere near neutral. The federal funds effective rate is minus 6.8, the worst that it's ever been. On the triple Qs, we have major support at around the 293 level. Again, whether we take out those June lows or not, same story as the S&P 500. But because the CPI numbers come out September 13th, I will likely keep all of these hedges open until then. And if we're up heavily on those hedges, then I may close them and then reestablish positions after the CPI comes out and after it is kind of evident what the Fed is going to do. As I said before, these resistance levels that we saw here, this was not the time to buy stocks. However, as the market continues to draw down, it is time to rethink about potentially purchasing blue chip stocks and indices that are down at a significant discount. I'm not saying right now, but between now and September 13th, if we get major drawdowns, which is very likely, close to those June lows, then I will start thinking about adding to my portfolio. I will certainly start thinking about selling cash secured puts, which we did back here in May and June. We sold cash secured puts on Tesla, on Apple, on the triple Qs, on the SPY. And those were largely successful because of this huge rally that we had since then. So right now, in terms of adding stocks, I'm monitoring, but I'm not looking to add heavily at this stage. But I promise to keep these updates coming for you. I will be starting a portfolio soon. I know that, I had mentioned this before. However, I'm positioning this portfolio as I would a new investor, and I would not have purchased stocks, at those resistance levels that we were at. So for me, it was a non-optimal point to start a portfolio. I will keep these updates coming. Obviously, we will live stream the main events, and I will go over the Tesla split trade in another video, probably the next video, so that you guys see what types of trades we made. I did go over it in the last video. I gave you all of my trade ideas for Tesla. Hopefully some of you guys took them if you were convinced of the thesis, but I will go over those Tesla trades as well in the next video, and we'll talk about what is next for Tesla. So stay tuned here. If you got anything out of this video, give it a big fat thumbs up. Again, signups are closed for August. If you want to apply for spots in September, click the link in the description below and book a call with one of our ambassadors. We'll be happy to have you if you end up joining. Leave a comment down below. Let me know what you think of the next inflation data. Let me know what you think the Fed is going to do. Subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.